back to FX Street, talking about cliffs. We certainly had something falling off a cliff last week, Harry. I was thinking about you every time we have downdrafts. I get your regular emails, and I admire your conviction and having stood through a lot of interviews where people actually kind of castigated you for your views, and it's amazing how the world can change. You're a warrior, Harry, and it looks like we're finally underway for this phase. You've sent me some charts for us to pay attention to, about 4 different charts, so I have them up on the screen. Welcome back to FX Street, Harry.
Yeah, nice to be back, Dale. First, let me just introduce real quick. I mean, our biggest thing has always been demographics. We saw the downturn in Japan coming in the late 80s when people thought they were going to take over the world, and with the same projections of when the baby boom generation was going to spend money or not increasingly, we were able to project that this boom would last into 2007. But ever since, it's just been nonstop quantitative easing and stimulus and zero interest rates, short and long term. So we're in an artificial recovery, and we would have been in a depression. We were starting to see a Great Depression in late 2008, the total meltdown of the financial system, and they just poured trillions of dollars around the world to stop that from happening. That does not solve the problem. So,
it's amazing it was amazing it was that simple, Harry, that, all this time we've been looking for signals, etc., on topping action in the S&Ps, and really all we had to do was just sit back and wait for the Fed to finally be in a corner and just move once. And it took a week or so for the effects to start to show up, and I know you've been very bearish China. So this is not, the first 3 days of last week was the worst start of a year since 2008. And you tack on the last 3 days, it's the worst start to a new year in modern stock market history. So I know a lot of people place a lot of importance on what happens in January, so goes the rest of the year. So why don't we start out with your first chart? This isn't a bubble with a question mark.
Yeah, I mean, the biggest argument I get when I get on these shows is I'm saying, hey, we're in another bubble, and they say, well, this isn't a bubble because of this, or this isn't a bubble because inflation's not high, this isn't a bubble because stocks are not as overvalued as they were in the tech bubble. And I'm like, well, Amazon is, and you can't expect this bubble to be as overvalued because that boom happened when baby boom spending was in its strongest decade, which only we forecast in the late 80s and early 90s, and we had a perfect geopolitical environment with nothing wrong in the world. Now we have everything going wrong in the world. So, but I keep throwing up charts like this, and I've got dozens of these. Every bubble in history goes up, and it starts going up more exponentially, and then it bursts. They don't ever correct. When they finally hit a certain critical point, they burst. It's like, the straw that broke the camel's back, because they kill themselves for their own extremes. And so here I show, if I'm debating somebody, I'd say, well, you do agree that late 94 to early 2000 was a bubble, and everybody say, oh, yeah, that was a bubble. Well, here's the S&P, the red line today, versus that bubble back then. The only difference is this bubble's gone even higher and lasted a little over a year longer. So this is a bubble. And I always tell people, I don't care what causes a bubble, whether it's an OPEC embargo or some supply shock, or whether it's excessive demand like the baby boomers coming into coastal cities and pushing up stocks and real estate and things around the world, or if it's just government stimulus. This last round has just been nonstop government stimulus around the world, and that money hasn't gone into lending and expansion because we already overexpanded in the boom. So this is a bubble, and bubbles burst. And if we look at the second chart, this is a chart I've been touting for over a year now. Each bubble, we've seen 3 bubbles. The one in early 2000, the one in 2007, and now in 2015. Each bubble has taken us to higher highs, but then when they crash, and they always crash, as you can see, they take us to lower lows. So my projection, and this is just the best projection I can make here, is that we have seen a top here in mid-2015, and we're going to have to go down in the next, say, year and a half or so, kind of like the 2008 crash, and go down to even lower lows, around 5,500 to 6,000, which means this next crash is not going to be 55% like the last one. It's going to be 65, 70% or more. So this is definitely something that investors want to get out of the way of. And I'm also saying it's the final bubble in this pattern. We saw the same thing when the last generation, the Bob Hope generation, was peaking in their spending in the late 60s. We saw a peak in 65, a crash, a higher peak in 68, a bigger crash, and then the final high in late 72, and then the big crash, 73 to 74. That was the final bubble. That was the final crash, and that was the one you really needed to get out of the way of. So most people are looking for a correction here if they're smart, and 9 out of 10 Wall Street analysts I debate aren't even looking for much of a correction. If you don't expect at least a 20% correction with stocks so overvalued and have gone so long without, and then next chart is also an important one that I don't hear anybody talking about, even though it's kind of obvious. I call it a rounded top. Yes. Into May of last year, we kept barely edging up the new highs. But ever since then, the geopolitical news just gets worse. The fundamental news around the world, again, we've been focusing on China's bubble is bursting and they cannot contain it. I don't care what anybody says. Nobody can keep a bubble going forever, especially the Chinese bubble so extreme. Germany has the demographics as bad as we saw for Japan in the 90s, and they're supposed to hold up Europe, and oil prices keep collapsing. Another thing the Federal Reserve and central banks can't control. You can stimulate your own economy, keep your own financial institutions awash with money and speculation, but you can't stop global oil and China and stuff from crashing. So we're seeing now every attempt to rally cannot make a new high, and that's very bearish. And we're coming on a critical point just below where we were on Monday. Around 1880, we would break what I call here, and just to keep it simple, a head and shoulders pattern. Left shoulder, you see S, head peak, and then a right shoulder. This is a very bearish pattern, and it's very consistent. It's one of the most consistent patterns. We break 1880 in the next couple of weeks, and we're bouncing right now, and we're oversold. That would be the next sign of, hey, this thing is going to start to break down a lot harder. And again, that might take days, that might take weeks, longer, but that's the key place I'm looking for now to say, okay, I am convinced now we have topped. And the final reason, if we look at our final chart here, the everyday stock, I've got the value line geometric index here, which is very simple. It's a broad index of stocks, unlike the Dow or even the S&P with just 500, and it is equal weighted. Every stock is counted the same. So these markets have been dominated by what they call the FANG stocks, Facebook, Amazon, Netflix, Google, and Apple, and all these sort of things. And they dominate the market because the markets are weighted for their huge capitalization. I just showed yesterday in my newsletter that Amazon has 870 times earnings right now, and people are still piling into it. So if you look at this blue line here, the broader stock market's already in a bear market, down 21% recently. When the broader when the S&P and Dow are only down like 10%. We are already in a bear market, and when you get this big a divergence between the everyday stock and the large caps, that is the classic sign, along with the against decline line, which also measures this, but I use this chart because it's simpler to understand. That's the classic sign that the bubble or a major bull market is finally peaking. The dumb money is piling in, buying the brand name stocks that everybody knows, and the smart money that buys better value and small cap stocks are leaving. And so this is a sign. I am convinced we have seen a top. We're due for a rally here. I'm telling people this market is a sell on rallies, not a buy on the dips. And these traders that keep buying on the dips are just going to keep getting punished, and you don't need to be one of them.
Harry, you're an expert. You're an expert in the bubble arena. In most arenas, most bubbles do retrace around 70–80%.
Yeah.
So I was going to ask you, did you find this top unusual in nature? Because usually Wall Street doesn't give people a year to put on a position. Bears to be getting short of constant failing rallies up against major resistance. Normally it's some type of spike blow-off rather than a huge distribution top like we had last year. Did you find that unusual?
No, because we've been going. Yeah, because this is different. The 94 to 2000 bubble, we call that in advance. again, the strongest spending of the entire baby boom wave of spending from 83 to 2007, which you can project very easily for peak spending. And, again, a perfect geopolitical environment and falling inflation. All things we can predict on our cycles, our long-term cycles. So that was the perfect thing. That was a classic, even more exponential bubble with even higher valuations altogether. Well, the 2007 bubble that followed had bad geopolitical trends. It was not as strong, and it had more of a rounded top like this, and now this is the most rounded. The reason this top looks different is that it's purely from artificial stimulus without the endless QE around the world and zero interest rates. And Dale, it's not just zero short-term rates. When you adjust the 10-year Treasury for average inflation rates of 2% in the last several years, it's zero today. Even long-term money is free. So this is the only thing that's kept the markets going. And the markets keep believing, well, the Fed won't let the markets fall. Well, they're going to be disappointed in that. So that's the point of this rounded top. They keep trying to rally and do the same old thing they've been doing for 6 years now. And because the fundamental trends are going against them, China market keeps cracking up, oil keeps going down, Europe keeps having more and more problems. Now they got 3 million refugees to deal with on top of everything else. The fundamentals and the geopolitical trends, as we've been predicting, will continue to go into this market. Most economists and investors are thinking, hey, if we can just get over this 2008 crisis, we'll hit escape velocity and everything will be hunky-dory. We're like, no, the fundamental trends get worse. So this market's going to keep fighting this until something bigger goes wrong. And I'll tell you the biggest thing, Dale. I am looking at the Chinese market going to new lows. It crashed 42% in 2.5 months, just like the U.S. in 1929. The U.S. stepped in and bought its own stock market like China did today. That lasted about 4 months, and then the whole thing caved. China breaks down to a significant new low. I think that's when this thing blows. Not going to happen.
People can't have it both ways, Harry. After the financial crisis, they said China was going to be an engine of growth that helped our recovery, and they can't have it both ways, that if China's imploding, it's not going to have an impact. In fact, people are saying that China's going to export and is exporting this deflationary trend across the globe. I wanted to ask you, where would this count or this view be invalidated? Because in your readings, you did offer an alternate scenario last year, that we could just pull back 20% and then get one more hurrah in the market. So if we do pull back 20%, is there still a chance, or is that off the table now?
No, that is still a possibility. It's looking less and less likely now because, again, the trends just keep coming in against the market. Now we got earnings seasons coming, and earnings went down in the third, fourth quarter of last year for the first time in a long time as well. And normally the stock market would already be down more than that because of this. So that's why I'm looking at that pattern before. If that head and shoulders pattern works out, that projection would be about the 1595 on the S&P 500. Let's call it 1600. That would be 25%. That would be more than a normal bear market. And that, to me, would be the sign that this bubble has peaked. Until that happens, there's still a chance that we could see one more rally to slight new highs. And to me, that would be even more bearish.
That would be a gift. I would love to see that, Harry. You know, I know your mission is... I know your mission is...
That's why I don't think we'll see it. It would be too good.
Yeah, for people to say, well, I'll just wait for one more high. They'll be waiting the rest of their lifetime. I know your mission is capital preservation for people, Harry. You don't want people to have to live through what they have twice before with financial panics in the market. And a lot of people, and I follow what you say, are hanging their hats on, they believe you're right about what could happen to equities, but they're hanging their hats on the gold market. And you are just as bearish gold as you are the market. You're talking numbers down the road, 750 and even an extreme of 250 in gold down the road during this deflation. So I know that's also part of your mission, because people that are called gloom and doomers because they're bearish stocks, most of them are bullish gold. So I want you to just inform our public that are going to coin stores and burying Krugerrands in the backyard that may not save the day for them, and why.
Yeah, in fact, it definitely won't. We've been saying this for years. It's not a recent forecast. And I've got so many
Right.
bets with gold bugs, you can't count them. And I'm winning all of them. There's a couple things people need to understand. First of all, like I always show the bubble, like gold was a bubble. I was debating Peter Schiff in St. Kitts, and he said, all these things are bubble, bubble, bubble. He said, but gold's not a bubble. I'm like, what? It went up 600-700% in 10 years. If that's not a bubble, that's worse than the stock bubble we've seen in most other bubbles. So it's a bubble, number one. Number two, gold is misunderstood. It is not a crisis hedge so much. The worst crisis we've seen in the world in the last 10 years was late 2008 when the entire financial system was melting down and gold went running for mommy because we saw a brief bout of deflation. Gold is an inflation hedge. We got charts back hundreds of years. When you adjust for inflation, gold goes nowhere. In recent times, gold went up with inflation in the 1980 and crashed with that commodity bubble, and it went up again, especially when they saw all this quantitative easing. Gold thought at first quantitative easing is going to cause massive inflation. We said no. These central banks are merely using a fire hose to fight deflation. Deflation is the trend. That's why you don't want to be in gold. And the third reason is gold is a commodity. It's no longer money. Try to take your Krugerrand down to the 7-Eleven and buy some bread, damn it. You know, you're not going to be able to do it.
You can't eat it.
It is a commodity, and the commodity cycle is something we've also been warning for years. Peaks on 30 years like a clock. 1920, 49 to 51 double peak, 1980, and then a double peak between 2008 and 2011. Commodity prices have led this whole downturn because they're responding to the slowdown in China. China consumes 40 to 50% of most industrial and energy commodities. So they're the 800-pound gorilla. They overstimulated, overexpanded. Their balloon and bubble is bursting. Commodity prices are not coming back anytime soon. I think gold's going to be at 700-ish within a year and a half, by mid next year at the latest, 2017. And I think it's ultimately going to bottom somewhere between 250 and 400, because I'm doing the same thing you did before. You're exactly right when you say most bubbles collapse 80% or more. Right. So gold's got to go back down to 250 to 400 to erase that bubble. It's not erasing all the gains throughout history, just the bubble. Real estate in the U.S. has to go down 40% or more to erase the bubble.
I sold my house 2 years ago. Always early, Harry. Do you know what that's like? So
I know what it's like.
But and your interesting, and your interesting point about real estate is that people die, but houses keep living on.
Exactly, and that's unique to real estate.
Okay, so I'm here in San Diego. We've taken out the '08 highs on the coastlines here, Harry, and a lot of it's been Chinese money coming in here, buying $1 million homes for their kids to go to college in.
Yeah.
So if
they're doing that to launder their money outside of China. That's the only way they can legally get their money out of China. They are running from their own country.
So what's going to be the catalyst for another leg down, that we never retrace the real estate bubble 70-80% after the '08 financial panic led by housing? What's going to be the catalyst to take it down this time? Is it just weakness in asset classes that people have to sell? Or again, is it the demographics? There's no demand? Because I've read that there's another generation, I don't know if it's X, Y, Z, I'm not sure what letter, it's Y, that the demographics are actually okay for them to come in and buy houses, but perhaps they don't have the means because they're saddled with student loan debt.
It's partly they've seen a real estate crash early in their life, which the baby boomers never saw. We never thought real estate would go down as a generation. It's more importantly what you said earlier. It took me years to get this. I was looking for Japan had their bubble burst in real estate and stocks way ahead of us because their baby boom peaked into and just after World War II, way ahead of ours in the early 60s. So they had their stock bubble burst. They had real estate burst. Well, when their next generation, the millennial or Generation Y, came along, I was looking for some sort of bounce. Well, we didn't get it. Real estate's still down 60% and went down way more than we've seen. And the reason it didn't bounce, I finally figured out when I saw a quote that said that the Japanese are selling more adult diapers than baby diapers. It clicked for me. Oh my gosh, old people are dying and old people are sellers. And like you say, Housing lasts forever, unlike most consumer products. So what's happening in Japan and what's going to continue to happen in the United States is the dying of the baby boom generation over 20, 30 years to come into 2039 actually is going to cause net demand for housing to keep going down, and it will turn negative, maybe several years from now, and we'll actually won't need any more homes forever. So how is housing going to have a strong bounce back, or how's it going to keep going up even with this new generation when we've got this sort of dynamic?
So will interest rates play a role in this at all, Harry? Bonds are still pretty sanguine, but they're not acting that great compared to what I would have expected after last week on the flight to quality. The bonds really didn't perform that great. Will interest rates play a role in real estate coming down?
Well, often in the early stages of a crisis, interest rates can bounce up, and I think it'd be more international. You've got unbelievably low interest rates, 22 basis points on a 10-year Japanese bond when they're bankrupt, 56 basis points on a German 10-year bond, and they're about to go, slow down unbelievably and have huge debt crises in Europe. So there's a kind of a realignment. Even Italian bonds, I mean, they're almost bankrupt, and they're only yielding like 2% close to our bond. This shouldn't be. So there may be a short-term readjustment in rates, but the U.S. Treasuries, as a general rule, are going to, after maybe spiking a bit in the next several months, they're going to head down for many years. From late 1931 into 1941, Treasury bond yields went down even lower, like to 1 to 2% on long-term bonds, even though the worst of the deflation happened in the 1933, because investors just started seeing a shift from, oh gosh, we used to think inflation, now we got to look more for deflation. So that's a positive for housing. That's a positive.
And I'm going to go ahead.
But with more people buying than buying, there's no way to offset that trend, even with low interest rates. I mean, interest rates are low now, and housing's not doing well.
Am I assuming correctly with your view on gold and deflation that even though the dollar has taken a pause and moved sideways since Draghi disappointed a few months ago, that you're looking for a resumption of the bull market in the dollar? And do you think this will be the year that we see euro under parity?
Yes. We've been looking for euro under parity for a long time. I think it's going to happen in the next couple of years. The biggest thing we see, Dale, is the dollar went down 58% in the great boom from 1985 to 2008. It has been bouncing ever since. All these gold bugs say, yeah, gold's going to go to $5,000 to $10,000, dollar's going to go to zero. We're like, no, we're the best house in a bad neighborhood, and we created far more dollars here and around the world than euros or yen or yuan or any other currency. And when we have this big shakeout in debt and asset bubbles, which literally destroys money near permanently for many, many years or even decades ahead, debts get wiped out, bubbles burst. This is money that disappears, real money that people were planning on spending and accumulating. Then the more you destroy a currency, the more valuable it gets. That's the paradox the gold bugs don't get. The dollar has gone up since the beginning of the crisis in January 2008, since the first recession began, and whether we've been in downturns or upturns with massive printing, the dollar has still gone up. It's 40% higher than it was in January 2008. I'm just seeing the dollar rebalance, and I think that rebalancing could happen by sometime in 2017, and then I'll become more neutral. But I still see 20-30% upside on the U.S. dollar, and I see almost every other currency, including the venerable Swiss franc, which has been collapsing, going down, and that's been the trend. Dollar was down from 85 to 2008. Most currencies were up, and ever since 2008, most currencies are down, and the dollar's up. It's a very simple formula. The dollar is the safe haven, and when gold was down 33% in the second half of 2008 and silver down 50%, the U.S. dollar was up 27%. If you want to protect your money, keep it in U.S. denominated securities. If you're a foreign investor, have your money in U.S. denominated securities to get the dollar play.
So I believe it's a great service that you're providing should this crisis unfold, Harry, and it's a wonderful thing to sidestep a financial panic, and even a greater thing to capitalize on it. But with this scenario unfolding, I believe there's going to be a lot of social unrest. There's going to be a lot of tension in the streets, a lot of people. We already have invisible breadlines. It's going to be tough in the U.S. for a majority of the population. So there's potential of bail-ins. So it's one thing to protect your assets, another to increase them. But what do you do to protect yourself against a lot of the draconian type measures that may come to pass as a result of this financial crisis?
Well, the number one thing is cash and cash flow are king. If you can turn real estate or stocks or any financial asset into short-term liquid cash-like, safe short-term bonds, you're preserving your money while bubbles are bursting, which means it's increasing in value enormously versus all other financial assets. So that's number one. Sleep at night, be out of the markets, and wait for different bubbles to burst. And they're not going to all burst at the same time. Real estate's going to take much longer to burst and happen slower as a general rule than stocks, just like last time around. The number two thing is you can actually take part of your portfolio and just be short things, short gold. Gold is bouncing now. We've been predicting this too. But if it gets up to about 1,300 or something, I would short gold. You can short stocks on any bounces here. Just have some that can say, look, if things go down, I'm going to actually make money and not just preserve my money. And third, there are people who have proven trading systems. We have some of these at Dent Research. I don't do them because I'm not a trader, but people who can go long, short, who can play volatility. So you have those three choices depending on your risk tolerance. I advise most people sleep at night. So just sidestepping the bubble is going to put you ahead of 99% of people in this country who are going to get wounded badly, and next time we're not going to come back to new highs. That's my forecast. Just like after the 73, 74 burst or the 1929 to 32 burst, we didn't get back to new highs, for 25 years after those major tops. So this is the time to say, look, I'm going to at least suspect that we could have a volatile period ahead. So I'm going to get out. And hey, if we don't see something happen the next year, then you can question what I'm saying. But I think this 2016 is going to be the next 2008, as I showed earlier. But it's going to be a more dramatic drop and in a similar period of time. So you really want to get out of the way of this.
So what's everyday life going to be for us to go to the grocery store? And with this type of crisis hitting the U.S. and the globe, don't you believe that life will not be the same? It will be different this time. And a lot of people are considering havens and sanctuaries that they'd rather watch it on TV than be in the middle of it. Do you give any thought to that, Harry?
I do. I tell people, look, it definitely, I'm the most worried about China because they've got 500 million people and with no skills, moved into cities, building stuff for nobody. When that musical chairs ends, they are really in trouble. U.S. has very polarized politics, the worst income inequality in the developed world. That's not a good sign. This is not a time to go driving up to the 7-Eleven in your Ferrari. You've got a Ferrari, sell it and get a Volkswagen or something.
Go low profile.
Yeah, go low profile. Don't show off your wealth. Protect it, but don't show it off. And I own no real estate except for my safe haven. I've got a safe haven in the Caribbean that is getting more favorable zoning, number one. But number two, it's my place to go if things get really bad. And I, like you say, want to be watching it from afar. I've been told people in my books for years, where you live is as important as protecting your assets. If you have a choice between being in the outer exurbs of a city like I am in Tampa, that's better than being downtown, or in the main or denser areas. If you can be anywhere between the two mountain ranges, Rocky Mountains and Allegheny Mountains, in the middle of the country, less of a bubble, less carnage, that's better. If you can live in a small town that maybe got a university or something and a good standard of living and plenty to do, that's the best. So where you live, because I don't know, this is kind of unprecedented. I don't know how bad the civil unrest is going to get, but there's got to be a good bit in the United States, given the polarization of the left and the right and the rich and the poor, and the most guns per capita of any developed country in the world.
Thank you for sharing that, Harry. Who's going to win the presidential election next year?
I'm not commenting. Well, first of all, I don't endorse candidates. I stay apolitical because we want everybody to benefit from what we do. But what I do say, and remember, Barack Obama came out of nowhere, and I mean nowhere, and beat the favorite candidate, Hillary Clinton. I think if stocks collapse this year, as I expect them to, and the economy goes into a deeper downturn, it's going to favor the outliers. It's certainly Jeb Bush is already dead, and Hillary Clinton still looks supreme, but I think that could change. So, and you can't count out somebody new stepping in, especially on the Republican side. So we'll see. I think we won't know till we get very close to the primaries in July for both parties, and then it'll be more obvious. Right now, I think anything could happen, but I do favor the outliers, and it's certainly looking good for Trump on the Republican side.
Thank you so much, Harry, for your time today and edifying our community. Just like your Megaphone formation, this was your third appearance, like the third top on the Megaphone. And also, thank you for offering your book, The Demographic Cliff, to attendees. And all they have to do is pay $4.95. You sent it to me after your first visit, and I found it very informative. And again, Harry, it's always a pleasure to speak to you, and good luck on your mission. And let's try and save as many people from heartache as possible going forward.
Yep,
thank you, Harry S. Dent.
Thank you, Dale.
Great having you. Everybody, thank Harry for his time today.